Earlier today, SVB Financial Group, parent to Silicon Valley Bank, dropped more than 60% and in the after hours fell another 20%. What is going on with Silicon Valley Bank? Can shareholders potentially recover? And will this lead to a stock market crash? You're watching Unrivaled Investing. Let's dive in to understand what's going on to Silicon Valley Bank. Well, you have Peter Thiel from Founders Fund, high-profile venture capital firm, recommending to their portfolio companies that they should pull their capital from SVP. And he's not the only one. You have Coatue Management, Union Square Ventures, several high-profile firms saying, hey, pull your capital. If we've invested in you as a portfolio company, you shouldn't keep that capital in Silicon Valley Bank. And this was very popular, very trendy for a lot of Silicon Valley startups to invest it in Silicon Valley Bank. And now they're saying, hey, it's not necessarily safe. You may not be able to pull back 100 cents on the dollar. So pull it now before there's potentially a problem. That's what they're suggesting. And that's what's going on with this Bloomberg article. Then you have Michael Burry. He was always excited to chime in when there's a little bit of chaos going on. And he typed in holy hell on Twitter, then posted, it is possible today we found our Enron, making comparison to the .com implosion. So what's going on with Silicon Valley Bank? How should I explain this? Well, first of all, in full disclosure, this is not financial advice. So when you look at Silicon Valley Bank, and very quickly, just looking at their last financial report, you could tell that they were in trouble to the tune of at least $15 billion. I encourage you, if you're not familiar with financial statements, I do have an educational course both on financial statements as well as valuation analysis. I made these designed to say, hey, based on my experience on Wall Street, like what would I have wanted to know when I first started? And this is based on that experience. So looking at financial statements, within a few seconds, you should instantly see, okay, there's potentially a problem here with Silicon Valley Bank because they have $90 billion, nearly $100 billion in held to maturity securities, of which the fair value is only $76 billion. So there's immediately a $15 billion hole on their balance sheet. And so the reason why you have this sort of differential, what is fair value versus held to maturity, mark to market. So you have, this $91 billion value, and they actually say their fair value is closer to $76 billion. That delta is because as interest rates rise, a lot of bonds that are longer dated fall in value. And Silicon Valley Bank invested in a portfolio, a $100 billion portfolio at one point, in various different bonds. They weren't necessarily super risky. They were like mortgage-backed bonds, treasuries, but they were longer dated bonds, such that as interest rates rose significantly in the last year or so, they were cut off guards. And this does reflect that management at Silicon Valley Bank wasn't doing a good job, that they were reaching for yield and investing in things that, hey, if interest rates move up a little bit, you're in deep trouble. And they held to maturity means, hey, if we are able to hold these bonds to when they mature, this is the amount we expect to get. You're allowed to do that as a bank from accounting perspective, but they also report these bonds actually trade at a $15 billion lower valuation. So that's an important recognition that there's a $15 billion hole on their balance sheet, like if they liquidated today. And that's a problem because you have $80 billion in non-interest bearing demand deposits where effectively depositors as of 12/31/2022, they could just pull that capital if they wanted to. In which case, then Silicon Valley Bank management's going to say, okay, so what are we going to liquidate? And that creates a challenge. And you could see that was already starting to play out during the past year as non-interest bearing demand deposits declined by $45 billion. In which case, okay, so what are we, tapping it into? Okay, well, instead we're going to, some of the capital is going to shift over to interest bearing deposits. Okay, so maybe it's really only a $20 billion decline. Well, where is it going to come from? What capital are we going to tap? This problem, this $15 billion hole is potentially even bigger because they also have their loan portfolio, which targets, private equity, venture capital related firms. And at least 10% is on the very high risk side, talking with, growth stage companies, very small companies, over $5 million in revenue, and some companies that are between 0 and 5 million in revenue. So this is a much, that hole, that $15 billion hole might be closer to 20 billion. It's unclear where it is, but there's a concern that this is a hole. And management also calls out like, hey, this capital that we've provided to these venture capital related firms, these firms that have received venture capital funding, well, they've historically been dependent on the ability to raise new capital. So, and they even mentioned that in their presentation. So if you have a tougher environment where you're not able to IPO a new company, or you're not able to raise another up round because, hey, frothy spirits or tighter capital requirements, Jerome Powell, then you're going to have this problem of like, oh, well, previously we provided these loans expecting you to have an exit. You didn't have this exit, and now we're stuck with this loan on our book, and will you actually be able to repay it? So that $15 billion hole is potentially bigger. Relative to the equity in the business, this is a big, big problem because they only have $16 billion in equity as of December 31st. So they're effectively insolvent if they had to meet their depositors right now. That's the reason why you're seeing very smart investors say, hey, pull out before there is a problem, because we don't know if a white knight is going to show up and make sure that everything's solvent at the end of the day. That is the big concern, because the concern is, hey, our deposit base, these depositors might not get back 100 cents on the dollar. And so, especially when you have a hole of at least $15 billion versus equity of only $16 billion. So what's management doing? Well, that's why the stock was down today, because they announced, hey, we're going to raise a few $1 billion. We got to plug this hole. And meanwhile, we recognize our deposit base is quickly, lining up to leave, $80 billion direct deposit, people looking to pull their funds that they easily can. And so what they're doing is they're quickly liquidating their available for sale securities. So this is the most liquid portfolio, selling what's liquid. And they sold $21 billion of securities, resulting in a nearly $2 billion loss. So they already, that $15 billion or $16 billion in equity, that's already down a bit because they had to sell, what was available, not even the held to maturity securities, the things that were less liquid. They had a more liquid portfolio that they sold, already generated nearly $2 billion loss. So their equity is already starting to take a hit. That hole is getting bigger in terms of thinking about this business and where they're at. This is creating a real problem. Okay, so is this going to crack the market? Is this going to crash the market? Are shareholders going to recover? What are sort of my thoughts from here? Well, first of all, one should have some context on where we are. I mean, literally same day, you see Silvergate, another crypto-oriented bank. Now, I shouldn't say another. It's a crypto-focused bank. Silicon Valley Bank is more, venture capital, Silicon Valley focused. But Silvergate, announced, a much smaller bank, announcing, hey, we're going to liquidate. And so you have that. You have Jerome Powell earlier this week. He's talking, on Congress, and he's effectively saying higher rates for longer. And by the way, it's in order to bring inflation down, we might have to see several million people unemployed. So far, we're not seeing that. And then you also see President Biden earlier pitch a new tax plan, new budget, that would include raising corporate tax rates, reversing the previous tax cuts from President Trump, raising rates from 21% to 28%. This alone would warrant the stock market going down by about 10%, at least. If you have, higher tax rates, lower earnings, and then you have all these other challenges of higher interest rates, higher unemployment, corporate earnings going lower. I mean, this alone is a ugly, ugly, ugly setup. So how am I thinking about it? What am I doing? I personally call out what am I buying and selling. I share what I think are compelling ideas with my subscribers at unrivaledinvesting.com. A few thoughts. First is that if no one shows up to save Silicon Valley Bank, and there's a continued run on the bank and depositors pull their capital and they just say, hey, we don't have liquid assets that we can sell, we're in deep trouble. And they ultimately force depositors not to get 100 cents on the dollar. That is really bad. And I suspect if you have a situation, especially with $100 billion, where depositors get a discount, where depositors get a haircut, then when depositors start losing money, that's when you can start seeing things crash hard. Now, keep in mind, this brings back, memories from when I was on the trading desk, during the great financial crisis, and I was looking at bank stocks and literally bank bonds and thinking about what's the recovery value for these banks? How levered are these? In this case, it wasn't necessarily over leverage, but just poor capital allocation. $16 billion versus $200 billion in assets. It wasn't like it wasn't like how the investment banks were previously leveraged in the great financial crisis, 30-to-1 type of things, like Bear Stearns. That's not what the case here. Here is interest rates moved faster than they expected, and their portfolio, their bond portfolio really stunk. So if no one shows up, and this is part of the concern about where we are in the capital cycle, because Jerome Powell is still tightening. He's not in a position to say, hey, let's make life easier. Let's, provide lots of capital to folks. He's still saying, hey, my number one enemy is inflation. So he's going to probably say, I suspect he's going to say, hey, private markets, do your thing. So that we'll see. We'll see if someone shows up. We'll see if someone's willing to buy their loan portfolio, effectively stabilize their deposit base. So that would, immediately impact whether or not you're looking at a hard stock market crash type of scenario. The second concern is, do you start having contagion risk where other banks start falling in sympathy? And you started seeing that today because they have similar problems. Now, it's unclear, how bad it is. And, it's the banking sector, by the way, is much, much, much healthier than what it was during the great financial crisis because the leverage is much lower. But if you start seeing other banks potentially face this risk, and you still have the Federal Reserve not in a position to really step in to say, hey, we'll make sure everything goes smoothly, that is another thing to watch for. So the first is, do depositors get a haircut? Second is, do you see contagion where it starts spreading to other bigger banks? Maybe you see something like Credit Suisse start showing real problems. I'd say the third thing to think about right now, and from your own investment journey, is to consider businesses that can benefit from this investment environment. I previously called out, Warren Buffett's Berkshire Hathaway. I mean, they have like $100 billion plus in cash. He's going to benefit from this chaos, especially because all these private equity firms, they can no longer be as competitive because interest rates have moved higher. So look for the companies that can benefit. My largest position is a company trading at like 8 times forward earnings, multi-decade history of compounding at a high teens rate. And they've absolutely crushed it as interest rates have moved higher. They were extremely well positioned for it, and they're excited for chaos. I mean, they will benefit from this. So that's how I'm personally thinking about it. Like every company I'm looking at, I'm thinking, will this benefit if there's potential chaos? Does management have the chops to do the smart thing, do intelligent capital allocation if times get rough? That's how I'm trying to think about my portfolio. Will they allocate intelligently? Are they in a position to? Will Silicon Valley Bank recover? Sort of that fourth point in question here. That's really tough. Like, it would require, this is the reason why, Warren Buffett talks about you never want to have to rely on the kindness of strangers. That's Silicon Valley Bank right now. They need to require, they are the kindness of strangers up the wazoo. Like, they need to require on the deposit base needs to not leave. And they need to be able to easily get capital to fill that gap and just sort of sit tight, because like if investors, depositors were like, it's going to be okay in time, that gap will close because if you hold these bonds to maturity, it'll be fine. But that's where it depends on the kindness of strangers. And so I just look at something like this. I don't want to own anything that depends on market sentiment being kind to you tomorrow. I want to own things that benefit from the market being closed tomorrow, where they're like, oh, we can make private deals at huge discounts. And so I just look at this and I'm not sure Silicon Valley Bank can recover from this. I'm very skeptical. If anything, I would suspect that someone's probably encouraging them to look for an acquirer. So we'll see. Maybe I'm wrong. As I said earlier, it's not financial advice, but based on my prior experience looking at distressed banks, we'll see. I'm personally not long Silicon Valley Bank, and I'm sorry for anyone that's feeling the burn from watching that 80% drop recently. So as always, if you're looking for the compelling ideas and my own personal portfolio updates, consider unrivaledinvesting.com. We also have an exclusive community on Discord that's only available for annual subscribers, where I personally let in every single member that looks to join that's an annual subscriber. Thanks so much for watching. Please hit that subscribe button.